Hey everyone, welcome to today's Explainer. We're going to be exploring the architecture of the markets and breaking down trading fundamentals for absolute beginners. We're cutting out all that confusing financial jargon to give you simple, digestible knowledge that you can actually use. Let's be real for a second. You want to trade, right? But the second you look at a chart, you just feel totally confused. Honestly, it's a completely normal feeling. All those flashing lines, colors, and numbers, it can feel like you're staring at an alien language. But don't worry, today, we're going to translate that language together.
So here is our roadmap for today. First up, trading basics. Second, charts and candles. Third, trends and levels. Fourth, risk and psychology. And fifth, beginner mistakes. Let's jump right in.
Okay, Section 1, Trading Basics. What actually is trading?
Think about it like this. Imagine you buy a mobile phone for, say, 20,000 rupees. A few days go by and suddenly everyone wants this specific phone model. The demand shoots up. So you decide to sell it for 25,000. Well, that 5,000 rupee difference, that is your profit. That super simple exchange is literally trading in its purest form. And what's really crazy is that this simple mobile phone analogy, it scales up directly to the biggest financial markets in the world. Seriously. Whether we're talking about stocks, gold, crypto, forex, the whole shebang, the underlying principle is exactly the same. People are just trying to earn a profit from prices moving up and down. You buy something, you wait for the value to change, and you sell it. That's it. So why do prices even move in the first place? Well, the market really only moves for one reason. It's basically a giant continuous tug of war between two forces. On one side, you've got demand. When buyers outnumber sellers, they push the price up. On the flip side, you have supply. When sellers outnumber buyers, they push the price down. That simple tug of war between buyers and sellers, that is the entire engine of the market.
All right, moving on to Section 2, Charts and Candles. Let's look at how we actually read market history.
People love to overcomplicate this stuff, but honestly, a chart is simply the history of price. That is really all it is. Every single line, every shape you see on a trading platform is just a historical record telling you exactly what the price was at a specific moment in time. As a trader, you're just looking at this history to try and make an educated guess about where the price might go next.
And to read that history clearly, traders use something called candlesticks. If we break down the anatomy of a single candle, it actually gives us 4 very specific pieces of information for a set time frame. It tells us the open price when that time frame started, the close price when it ended, the high point the price reached, and the low point it dropped to. These 4 data points are basically the building blocks of market history. Together, those data points tell a mini story. A green candle? That means the buyers were strong and managed to push the price up from where it opened. A red candle means the sellers took control and drove the price down. Every single candle is telling you a tiny, distinct story about exactly who won the battle between buyers and sellers in that exact moment.
Next up, Section 3, Market Trends and Key Levels. This is all about direction and invisible barriers.
Now, you might think the market moves totally chaotically, but it actually only moves in 3 specific ways. Number 1 is an uptrend, where the price is making higher highs and higher lows. It's basically climbing a set of stairs. Number 2 is a downtrend, making lower highs and lower lows, so walking down those stairs. And number 3 is sideways, where buyers and sellers are dead even, and the price is just moving flat horizontally. The really crucial part here is knowing where these trends might stop or reverse. And that brings us to support and resistance. Support is the floor. It's the area where buyers step in to try and stop a price from dropping any further. Resistance, on the other hand, is the ceiling, where sellers step in to stop a price from rising. Honestly, these invisible defensive lines are probably the most absolutely crucial concepts you will ever learn in technical trading.
But let's pause for a second. Ask yourself, is just watching the price enough? We've got our candles, our trends, our support and resistance levels. But if we only look at price, are we missing the real underlying force of the market?
Well, the answer is a massive yes. We are missing a huge piece of the puzzle, and that piece is volume. Volume equals market participation. It tells you exactly how many people are actually buying and selling right then and there. If the price breaks through a resistance ceiling and there's high volume backing it up, you know a lot of participants believe in that move. It makes it a much stronger, way more reliable signal.
Okay, let's shift gears a bit. Section 4, Risk Management and Trading Psychology. This is about mastering your own mind. I need you to commit this golden rule to memory right now.
Professional traders decide their maximum loss before they ever take a trade. Period. Pros never just rely on hope. They absolutely never risk all their money on one single move. They use strict risk management to predetermine exactly what they're willing to lose. And only when the math makes sense do they actually enter the market. And they do this because, trust me, the hardest thing to master in trading isn't some chart strategy, it's your own head. There are 4 incredibly dangerous market emotions that constantly ruin traders. Fear of missing out, greed to make too much too quickly, revenge trading to blindly try and win back a loss, and overtrading just out of sheer boredom. Getting a grip on these emotions is the real hidden key to long-term success in the markets.
Which leads us to our final part, Section 5, Beginner Mistakes. Let's talk about the pitfalls you absolutely need to avoid.
Consider this your definitive checklist of what not to do. First, do not come in thinking you're going to get rich quick. Second, do not start trading real money without learning the basics first. Third, never trade without using a stop loss to automatically protect your capital. Fourth, stop blindly following social media signals instead of doing your own homework. And finally, please, never ever put all your money into one single trade.
Just remember this quote, trading is not magic, it is a skill. And you know, just like learning to play the guitar or speaking a new language, a skill takes dedicated, daily practice. You've got to practice first on a demo account with fake money. Only when you prove to yourself that you actually have the discipline should you ever transition to using real money. So I'll leave you with this to chew on. Are you willing to put in the immense, disciplined practice required to master your own psychology? Or are you just going to let the market master you?